Welcome to our consulting channel. In this video, we will be discussing the best S&P 500 index funds or exchange-traded funds to be your portfolio foundation. Our mission on this channel is to empower you with financial education, aiding you in making informed money decisions aligned with your dreams, goals, and aspirations. It's important to note that our content is not financial advice. It serves as an educational tool to assist your research and decision-making. Ladies and gentlemen, if you watch this video till the end, we gifted you a bonus fund that you should consider adding to your portfolio. On this channel, we are big fans of, arguably, the greatest investor of our generation, Warren Buffett, of the Berkshire Hathaway Inc., who famously said, "I recommend the S&P 500 index fund, and have for a long time to people. That investment strategy may not be exciting, but it has been a surefire moneymaker for patient investors." The questions we will attempt to answer for you in this video are the following. What is S&P 500? Why should we care to invest in it? And amongst the many funds and ETFs that track the S&P 500, how does an investor select the best of these funds? The goal of most professional Wall Street traders is to beat the S&P 500 index. However, research studies over a substantial period of time has shown that over 90% of them fail. The S&P 500 is a measure of the health, growth of the United States economy. In 2023, the performance was impressive with a growth rate of 27%. It is projected by analysts to grow by 30% in the next 2 years. The S&P 500 index was launched in 1957 by the credit rating agency Standard & Poor's. The S&P 500 tracks the performance of the largest 500 companies in the U.S. stock exchange. S&P 500 index funds are investment vehicles that attempt to replicate the holdings in and the returns of the S&P 500 index. They are a great low-cost way to gain exposure to the performance of the United States large-cap stocks from all 11 sectors of the markets. There are many funds that track the S&P 500 which are available on different platforms offered by various investment companies. For investors, especially for beginners, there is often a confusion on which to invest in. The question is, which should I invest in, as all of them track the same index, the Standard & Poor's 500 index? Exchange-traded funds, ETFs, that track the S&P 500 are the cornerstone of countless investment portfolios. Trillions of dollars are invested in funds that track the performance of the S&P 500 all over the world. Over the long term, it is close to impossible to build an investment portfolio that outperforms the S&P 500, which is why it is used as a basic investing benchmark. It is close to impossible to invest directly in the S&P 500, but you can invest in the many funds that use it as a benchmark by tracking its composition and performance. Therefore, most investors use ETFs or mutual funds that tracks this index for creating their investment portfolio baseline. The funds will be nearly identical to one another in terms of their performance and the holdings held within the ETFs or mutual funds. It is therefore important to pick just one for your investment portfolio. It is important to ensure that the holdings in the select funds or ETFs mirrors the holdings in the S&P 500 index. Just because it says S&P 500 in the title of the fund doesn't mean that it tracks the index. Pick the right fund diligently. Is it better to select an ETF or a mutual fund? It is important to note that both track indexes, but ETFs are generally more cost-effective and liquid since they are traded on exchanges like shares of stocks. On the other hand, mutual funds can offer active management and greater regulatory oversight at a higher cost. It allows transactions once daily. The investment company that owns the fund will charge a tiny little percentage that they take off the top of your investment in exchange for giving you that convenience of owning all those stocks in one easy fund. These are management fees, also known as expense ratios. They are used to manage the stocks in the fund. An important factor in fund selection is to choose a fund with low expense ratios. Investors should avoid funds with high expense ratios. These fees vary from 0 to as high as 25% of your portfolio yearly. The fees will add up over the life of your investment in the funds. Depending on the fund, the general rule of thumb is to look for funds with low fees, ranging between 0 to a max of about 0.5%. There are plenty of funds with close to zero in fees. It is important to stick with funds with low expense ratios. For example, if you invest in a fund with a 2.5% expense ratio, you will pay $25 annually for every $1,000 invested. It might not sound like much at the beginning, but as your account balance grows, so will the fees. Again, we will emphasize the need to select low-fee fund right from the start. Another consideration in the selection of a fund includes fund inception, that is the year the fund was created. The longer the years of operation, the more information that is available for the fund's performance evaluation. The fund's performance is a strong indicator of the return on your investments. The long history of a fund is a critical tool for the examination of the fund's behavior during the good times and in bad times. It is important to remember and understand that previous performance does not guarantee future performance. However, a 10, 20, 30-year history's rate of return is critical towards a decision of which fund of the S&P 500 to add to your portfolio. Additionally, there are funds with a minimum dollar amount required for the initial investment which may or may not affect the assets under management, AUM. The assets under management is a measure of the fund's stability. Generally speaking, funds with less assets are going to be volatile with market fluctuation, but funds with large assets tend to be more stable. For an investor, the larger the assets under management, the better for stability and the healthy nature of the fund. There are funds that are requirements for minimum to be invested. Also, if the fund holds stocks that have a history of distributing dividends to their shareholders, an S&P 500 ETF may or may not offer dividend payments. On the other hand, mutual funds are required by law to distribute dividend to shareholders if available. A quick recap. Select a fund that truly tracks S&P 500 index and not just in name only. Have holdings that mirrors the S&P 500 index. Review the required minimum dollar amount that can be invested. Choose lowest management fees. Consider funds with high assets under management. Carefully review the history of the fund and lastly distribution of dividend to fund holders. The list we have selected are amongst the best S&P 500 funds including mutual funds and ETF. The question then is it better to select an ETF or a mutual fund? ETFs are generally more cost-effective, tax-efficient and liquid since they are traded on exchanges like shares of stocks, called units. On the other hand, mutual funds can offer active management and greater regulatory oversight at a higher cost and allow transactions once daily, usually at the end of the trading day, often sold at the price figured out at the end of the trading day. The lists of S&P 500 mutual funds or ETFs recommended in this video includes both mutual funds and ETFs. After doing our due diligence, backed by many hours of reading and research, we recommend to you one of the following 5 funds that tracks the S&P 500 index to serve as the baseline for your portfolio. The first one is the Vanguard S&P 500 ETF. The ticker symbol VOO. As the name suggests, it is offered by Vanguard Investment Company. This is available on almost every major investment platform available for investors in the United States. In 2023, its return on investment was 28%. It has an expense ratio of 0.03%, with a dividend yield of 1.36%. The AUM as of the time of this recording is $1 trillion, with an inception date of September 2010. It has a minimum investment requirement of $3,000. The second one, also an ETF, is SPDR S&P 500 ETF Trust. The ticker symbol SPY. The former name was Standard & Poor's Depository Receipts, SPDR, and is offered on the New York Stock Exchange market and available on other investment platforms. In 2023, the return on investment was 29%. It has an expense ratio of 0.09%, with a dividend yield of 1.31%. The AUM is a little over $500 billion, with an inception date of January 1993. No minimum investment required. The third fund is the iShares Core S&P 500 ETF. The ticker symbol is IVV. This ETF was introduced in May of 2000 by BlackRock Investment Management. The return of investment in 2023 was 28.85%. It has an expense ratio of 0.03%, with a dividend yield of 1.35%. The AUM is $440 billion, with an inception date of May 2000. No minimum investment required. The fourth fund is SPDR Portfolio S&P 500 ETF. The ticker symbol is SPLG. This fund is another ETF administered by State Street Global Advisors Funds Management, Inc. In 2023, the return on investment was 29.47%. It has an expense ratio of 0.02% with a dividend yield of 1.35%. The AUM is $31 billion. No minimum investment required. The fifth fund is a mutual fund offered by Fidelity Investment called Fidelity 500 Index Fund. The ticker symbol is FXAIX. It is available on the Fidelity Investment platform. In 2023, the return on investment was 28.83%. It has an expense ratio of 0.015% with an annual dividend yield of 1.76%. The AUM is $480 billion with an inception date of May 2011. No minimum investment required. An honorable mention bonus mutual fund is the Schwab S&P 500 Index Fund, offered by Charles Schwab. The ticker symbol is SWPPX. In 2023, the return on investment was 28.25%. It has an expense ratio of 0.02% with an annual dividend yield of 1.37%. The AUM is $83 billion with an inception date of May 1997. No minimum investment required. We hope the information provided in this video will help support your research as you decide which S&P 500 ETFs or mutual fund to add as the base of your investment portfolio. We would like to hear from you. Do you have an S&P 500 fund you have in your portfolio that did not make our list? Comment below and share your reason for your selection. Beware of scammers. We will never ask for your personal information or solicit money from you. Thank you for watching. If you have derived value from this video, please don't forget to like, share and hit the subscribe button. Remember, invest in yourself and stay amazing.